Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss what Goldman Sachs has to say about the housing market, a ceiling that matters, the DIY market, and the JP Morgan Chase CEO on commercial real estate loans. Today is Tuesday, May 23rd, 2023. I am Byron Lazine, and the hot sheet starts now. Welcome back to the hot sheet. If you enjoy the hot sheet, you should jump into BAMX. It is our private community. The Facebook community is growing and will be the best community in the real estate industry. There are already things being shared there that are happening nowhere else. You get courses every single month and live stream access. So if you want more of this, jump into the BAMX community. The link is below. Hit the thumbs up, and thank you for coming back to the only live housing show on the internet, Monday through Friday. We do this every single week. I want to start with a little quote from Ivy Zelman. She is a Hall of Fame institutional investor, equity analyst. Ivy Zelman is somebody who covers the housing market in depth. And Steve Harney quoted her on Twitter. And I think this is a fascinating quote for everybody who is following along the hot sheet. This couldn't be more true for the value that we're adding in our markets. Ivy says, "We would never suggest that a real estate company could be successful without fully understanding local market trends, but ignoring macro trends or assuming they do not carry the same weight would be an equally erroneous suggestion. In our experience, the most effective industry leaders appreciate the appropriate balance between the two ends of the spectrum." Again, Ivy Zelman. Look her up if you're unfamiliar with who Ivy Zelman is. I couldn't agree more. And it's why we're doing this show. I know yesterday I had a comment. We didn't get to many comments yesterday, but we'll get to some today, about appreciating these macro trends. We do go into some local trends, but it's really your job to dig even deeper on your local stuff. And having that balance between the two, being able to articulate to consumers what they're seeing on mainstream media headlines, what those actually mean, and then relating that back to what's really going on in their market. That balance between the two is so critical. And again, it's why we're doing this hot sheet. So hit the thumbs up and thank you for spending the morning with us. Goldman Sachs has got some comments on the housing market that I would say are contradictory of what we covered and what Fannie Mae said yesterday. Now, Fannie Mae, again, if you go back and rewatch or re-listen wherever you listen to podcasts, Hot Sheet is available on all podcast platforms. If you re-listen to yesterday's Hot Sheet or listen to it for the first time, we talk about this Fannie Mae prediction. They're kind of off on their own, where they believe that housing prices are coming down, they're going to come down this year, and they're going to continue to go down throughout all of next year. Zillow doesn't believe that. Case-Shiller is not forecasting for that. CoreLogic's not in that camp, and many others are not in that camp. Goldman Sachs would appear to not be in that camp as well. I'm going to quote from Goldman Sachs: "The global housing market is showing some early signs of stabilizing, with house prices leveling out more quickly at a higher level than would normally be expected given the rapid rise in mortgage rates." Okay, we're going to talk rates a little bit here before the end of the show. Yesterday was not good. All right, Goldman Sachs again. "Indeed, house price growth has actually risen the last 2 months in Australia and Canada, and more recently turned positive in the US. When we say turned positive, it refers to month over month home price gains this spring. We saw that starting in February per Case-Shiller, the gold standard. Despite these patterns and the positive recent data, our relatively hawkish rates forecast and the possibility that we haven't seen the full impact of higher mortgage rates suggests that the risks to housing price growth remain to the downside." Okay, so they are projecting what I believe will happen is that we have this increase, maybe a pullback before we start increasing again in 24 on home prices. This is particularly in the euro area and other economies where tightening cycles is still underway. Okay. So more so there than maybe in the US. However, Goldman Sachs says, our analysts also suggest that the downside risk to house prices may be somewhat more limited than historical relationships and standard models imply. Why would that be? If you look back on history, when rates go up as violent as they have, you would expect, just based on historical norms, that prices would have taken a much more severe drop. Now, we know that there have been places like Austin or San Francisco or Boise, Idaho, where we did see double-digit drops, but that's not the case in all of America. And right now, out of the 100 major metros in America, 93 are going up in price, okay? That's because of this limited supply that we have, and because of the limited supply forecast far into the future, right? We don't see an abundance of affordable product coming on anytime soon. They're not building that product, and there's no indications that that product, when we're sitting at all-time low, near all-time low foreclosure levels, forbearance is basically disappearing. Where would that inventory come from? Remember, 4 out of 10 homeowners in America own their home outright. It's 42%, actually. It's above 4 out of 10. 42% of homeowners own nothing on their house. So that only leaves 58% to be disturbed. And we know how much equity all of those homeowners have. In fact, most of those homeowners earn an interest rate under 5%, many under 4%. The far majority of mortgage homeowners have a rate under 4%. That creates a really affordable environment for those homeowners. Okay. It's the homeowners that are buying at the peak now at a 7% that have to really understand, I'm staying here for the next 10 years. We know that when you stay anywhere for 10 years, right? I've shown this chart only a dozen times here on the hot sheet, that according to Case-Shiller, home price growth by months into each decade means you're going to be up 30% or more when you own in the decades. 90s over 30%. So far in the 2020s, we're at 40%. 2010s was over 40%. And even the 2000s, with the great financial crisis, up near 50% home price growth. You got to own in the decades. You got to own for the long term. The buyers that do that, even today at 7%, and at buying at a peak in their market, are still going to be okay. Ruthie, Las Vegas homes median price increased from $425,000 to $440,000 this year. Assuming that's year over year, I know that there was some months when Las Vegas had month over month declines, but yes, median price point at $440,000. That is actually the median price point that builders are building, $450,000, building new products. So kind of matching the new, product that's being introduced to the market. Of course, we know that the U.S. median price is below 400,000, so it's missing the mark on what the new product being built is. All right. So Goldman Sachs, I believe, with their statements, is not in the Fannie Mae camp. I don't believe there are many in that Fannie Mae camp. They're taking a very, bearish approach. Maybe you would call that conservative. You can go back and look yesterday on what Fannie Mae's thoughts are on this housing market. I don't tend to agree with them. I think there's too little bit of inventory. I do think Q4 we could see a price correction again before we see a 2024 where we have a lower interest rate environment, probably around 5 or maybe under 5, where we'll see more transactions pick up and ultimately prices stabilize. All right. According to Mortgage News Daily, let's get into some of this rate talk. The debt ceiling is all over the news. It's big news last night. I don't think they came to an agreement yet. If they did, let me know in the comments. No, it'd be all over. There are no deals. That's productive and professional, says the Speaker of the House with meeting with the president, but no debt ceiling deal yet. All right. So it's all over the news, but it's a different ceiling, according to Mortgage News Daily, that's commanding more of the bond market's attention. Okay. We wouldn't say that debt ceiling is irrelevant. Obviously, Zillow believes that if we blow through this debt, we don't come to a deal, we default, that transactions are going to drop from 4.3 million nationally down to 3.3 million. So you can say to yourself, there'll be 25 less transactions happening in my market on a broad stroke if we don't come to a debt deal. That's essentially what happened there, according to Zillow and according to Moody's. So we wouldn't say that it's irrelevant, because obviously that would be a big impact. But let's take a brief moment to address its implications for the housing and mortgage markets. The most direct effect of the debt ceiling debate is a general ebb and flow of risk sentiment to the market. If it's resolved without issue, investors may be slightly more interested in buying stocks and selling bonds. Okay. So that would put, the latter would put upward pressure on interest rates. The latter meaning if they don't come up with a debt deal. And it was a general theme this week. You saw uncertainty, what's going to happen. You're seeing the 10-year continue to rise. We hit 6.95% on the 30-year fix yesterday. We're looking like we could hit 7% today. Yeah, the 10 years back up. There it is. 3.737. It's up 0.022. We probably could see a 7% interest rate today. That would be the third time we've hit over 7%, the third time that we've tested that. Okay, these are the scenarios here. I'll show you this chart. This is all our charts and sources are down below in the daily download link. We've tested it, obviously, the end of the year when we peaked out at 7.37 right here. We tested it again briefly at the February timeframe, and now it looks like we're going to test it again with the uncertainty of what is happening with this debt deal. I think ultimately the debt deal, like I said yesterday, comes together, and we will see this 10-year drop, which will bring the 30-year drop. Okay, so if it doesn't happen, you'll see, and Zillow predicts that you'll actually see that 30-year spike up over 8%. Okay. The 10-year Treasury yield is a good benchmark for rate momentum. Some of this week's upward momentum may be attributed to potential progress on the debt ceiling, but we really didn't see anything compelling evidence that traders were on edge of their seats over political drama. It would take a true default on U.S. debt to royal markets, and that's tremendously unlikely. Okay. Now, what we have seen this week is a breakout from where we've been. All right. So here's the breakout on the 10-year Treasury yield. This is what's pushing up the 30-year right now. The 10-year is a good benchmark, obviously, for these interest rates. We know that. We follow it every single day here. And obviously, the 30-year broke out too. So since March timeframe until really now, you've seen a bounce between the low sixes to 6.75. We've now broken out of that. We're at 6.95 yesterday. And you can see here with the 10-year, we're bouncing between 3.4 to 3.6 generally. Okay. Anything at 3.8 would guarantee 7% 30-year fix, all but basically guarantee 7% 30-year fixed mortgage rate. We're probably going to hit it even staying below the 3.8. We might hit it today. I do believe this will pull back if a debt deal is announced, and you'll see investors start switching over to stocks, right? They'll start to invest in equities and stocks, which is what Mortgage News Daily here is saying. All right. Ultimately, when you look at the trend of the 10-year right now in 2023, when you take this longer approach, this longer look at it, it does look like you're starting to slide down. Okay. There's some belief that this could get back to 3 or under, which would be great news for the 30-year. You could see a 30-year at 5% if that happens. Okay. Certainly if it gets down to 3.25, that would be breaking out of that 3-4 range. Do see a trend overall, despite these ups that we're experiencing now, of it heading back down in that direction. We shall wait and see what happens with some of these decisions, obviously with Congress, with the Fed, and the overall economy. All right. That source and all those charts are below for you, down below. Obviously, the biggest impact on these rates has been this existing home sales, right? So the existing home sales are now at 4.3 million. Talked about that last week per National Association of Realtors. You can see how far that is off from 2019, where we were at about 5.5 million. When we started 2020, before the pandemic, we were up over 5.5 million seasonally adjusted. So we're about a million or so more off there. It's worth remembering that ultra low inventory is not just a talking point for housing market cheerleaders. It's legitimately suppressing sales numbers. Incidentally, it also stands as evidence that 2023 is nothing like 2008. So your daily reminder there that we're not experiencing a 2008. I included that chart in the daily download because I think that line on the bottom for any buyers who's like, well, 2008 timeframe, just have them follow that chart and read that last line at the bottom. And that is sourced from NAR and from Wells Fargo Economics. So I think that'd be valuable information for any buyer who's concerned about buying right now, even on if they're buying on a 10-year, 5 to 10-year window, that they're concerned that they're going to be buying too high. That's a good indication that you're going to be fine in the long term. This is not 2008. There's not a cliff coming that you're going to miss out on. All right, Lowe's missed out on its full year sales forecast. So Lowe's just had their earnings report, and they're saying, I think this is interesting to share because I would not have seen this coming. Lowe's cuts its full year sales outlook. They are saying that do-it-yourself projects have weakened. Okay, the home improvement realtor did beat first quarter earnings and revenue expectations, but the company's shares dipped off of their outlook for the rest of the year. Okay, they don't believe that do-it-yourself market, so that the homeowner coming in and utilizing Lowe's is going to be strong throughout the year. CEO Marvin Ellison says in the company's new release that number deflation, unfavorable weather, and lower spending by DIY customers hurt quarterly sales. He said lowered forecasts reflects weaker than expected consumer demand going forward. Yet he added Lowe's digital sales and its comparable sales among home professionals rose in the first quarter compared with a year ago period. So home professionals is rising, but not these do-it-yourself projects. With the low inventory, my belief was going into this year that you would see do-it-yourself projects and certainly contractor projects, which have gone up. I would have thought you'd see an explosion in both categories as people decided, well, I'm going to fix up that room that we're not utilizing. We're going to stay here. That the fact that people aren't doing that tells me that we may be in for, when this rate thing does shake out and we get sub 5%, we may be in for a bigger explosion in transactions than we anticipated. Because this tells me if people aren't willing to do, it's one of two things. Either people are running out of money and their credit cards are running up high, and there are some reports on that, and that would be bad, right? It means that we're going to be getting into maybe even a worse recession than we thought. Or it's that people are just going to wait this thing out. And when the interest rate floodgates open, we are going to see transactions like we've never seen before. Maybe back up over 6.5 million on a seasonally adjusted. And we're going to make up for lost time. I mean, they're just waiting, and it's like, I'm not going to go and make this my home for the next 5 years. I'm going to wait a year and go and get the house once the interest rates figure themselves out. Just thought that was interesting. I definitely didn't expect that outlook from Lowe's. Be interesting to see if Home Depot has the same outlook. Jamie Dimon, the CEO of JP Morgan Chase, he's got an outlook on the commercial real estate loan sector that isn't good. He said commercial real estate loans could threaten some banks. So this is more evidence that if there is going to be a real estate crisis, it is going to come specifically in the commercial loan division, and that's going to be office buildings. Okay, so commercial real estate is the area most likely to cause problems for lenders. According to Diamond, the offsides in this case will probably be real estate. It'll be certain locations, certain office locations, and certain construction loans. We just saw a construction loan deal with PacWest yesterday. You're already seeing credit tighten up because the easiest way for a bank to retain capital is to not make that next loan. So if you're working with the commercial investor and they're experiencing less opportunity in getting a loan, it's because banks are being very cautious about who they're going to lend to, how much they're going to lend. Deposits runs have led to the collapse, obviously, of three major banks. Diamond says there's always an offsides, and it will likely be real estate moving forward. There will be a credit cycle. My view is this will be very normal, but the exception is going to be real estate. If unemployment rises sharply, credit card losses might surge to 6 or 7%, Diamond said, but that will be lower than the 10% experienced during the 2008 crisis. I think everybody should be prepared for rates going higher from here, up to 6 or 7%. That's talking about the Fed, by the way. He thinks the Fed's going to continue to raise. The industry is already building capital for potential losses and regulation by reining in its lending activity. You're already seeing credit tighten up because the easiest way for a bank to retain capital is not make that loan. So be careful on especially office and commercial loans in general. Heather says, I think people are using their HELOCs to pay down debt or survive the risk of cost of living instead of home improvements. We have seen, Heather, to your point, something work, because I understand what you're saying. Hey, people are going to go get a home equity line of credit to, basically make it through these hard times. The Fed didn't want to see that. Okay. The Fed did not want to see a lot of people go out there and just pull equity out of their home like we saw in 2008. So they worked really hard to stop that from happening. And here's actually a great chart that shows how this has stopped. Okay. So the equity extraction, people extracting from a refinance, you can see that those numbers have just plummeted as the interest rates have gone up. They've also made it, they meaning the Fannie and Freddie have put on a fee to these home equity loans. So it's a higher cost to pull a home equity loan, a higher interest rate. Less people are doing that, but I agree with you, Heather. I think people that are pulling out of it at this rate, like if you're doing it with a 6 or 7% interest on a home equity and paying a higher fee to, with Fannie and Freddie, putting that restriction on January 1, you really got to be in trouble, because the numbers wouldn't make sense to do it for a kitchen or for a bathroom. Who the heck's going to go borrow against their equity at 7%, pay a higher closing cost fee to do the bathroom? That would be a poor financial decision. So I'd agree. The few people that are doing it, and those numbers have plummeted again, you can see that chart just dropping down. The few that are doing it because they're probably in financial trouble. Maybe it's a Band-Aid fix and then you can kind of regroup. That's a slippery slope, right? I think if somebody's in real financial trouble and they've got all this equity in the house, the best path might be to go sell that, pick up a rent. Right now, rent is across America $1,800 compared to $2,700 on a mortgage. So you can catch your breath for a year or two. That's not a bad option. I know, not every financial situation points towards, hey, got to buy right now. That's just the reality of where we're at. All right, 10 years up. We took a look at that. 30-year yesterday. Close your eyes if you're watching. It was up over 6.9. Oh, wait a minute. I thought it was 6.95. Let me refresh here. There you go. Close your eyes. 6.95. Yesterday is where the 30-year came in. Again, 10 years up. So we'll see what happens here today. All right. There you go. That's the hot sheet. Appreciate you guys being with me. If you want more of this, certainly check out BAMX and check out The Real Word today. We're reacting to an NBC News Nightly spot that I was on Sunday night. Yes, I was on NBC Sunday night. So we're going to react to that, as well as a decline in agents from NAR. Okay, so we've got some reactions to go through on The Real Word. That'll be up at 2 p.m. here on the channel. Make sure you're subscribed, and I'll see you in the comments. Until then, toodaloo.